Greetings, Ted Hicks, founder, CEO, and Chief Investment Officer for Hicks & Associates Wealth Management. Today is Friday, February 4th, and this is our monthly market monologue. I'm going to try to keep it a little brief because we just hosted our State of the Union webinar. If you haven't watched that, it is posted on our YouTube channel. So by all means, go back and watch that if you would like. Again, as a reminder, this is for informational purposes only. Not trying to make any individual recommendations. If you're not already a client of ours, if you have any questions, by all means, please feel free to reach out to me or my team. We'd be happy to see if we can help you. Again, you don't have to be a client in order to ask us a question. That said, also want to encourage everybody to make sure you've liked us on Facebook, followed us on Twitter, or subscribed to the YouTube channel. That way you're making sure that you get all the content as we post them throughout the year. Finally, one more thing before we dive in. I'm going to be creating a team for the V Foundation Victory Ride to Cure Cancer. I rode in this last year. That's me on the right. And it was a great ride. And one of the reasons why we decided to do this, not only because I enjoy riding, but also because 100% of contributions to the V Foundation go directly to cancer research. Nothing goes to overhead. Their overhead is covered by a different foundation. So that's the reason why we're doing that. If you have any interest in joining our team, by all means, feel free to reach out to me. Love to chat with you about that. And obviously, if you want to make a contribution, we'll help you do that as well. That said, this is a chart to try to illustrate why we've been talking about the need to look at risk differently. Okay, traditionally, what a lot of us have preached over the years is that you want to diversify your portfolio, and you put bonds in your portfolio, you put international, you put different United States sectors in your portfolio. Well, this is the data up to yesterday, okay? And what I'm trying to show is the fact that there's a lot of correlation. And this is something we've been talking about with clients for years. When it starts to go sour, things tend to act in a very similar manner. And with the fixed income environment this year, that is one of our big concerns, that the benefit of diversifying into bonds and things of that nature are going to have limited benefit. That is our concern. So what is on the screen is you've got 4 different equity indexes or different equity investments. Not recommending any of them. I'm just trying to show you. You've got the NASDAQ down 12%. You've got small caps or small company stocks down 12%. The S&P 500 through yesterday was down about 6.6 or 6.7. Then you've got international also negative for the year, but this is bonds. So bonds year to date are again negative. So this is why we think we need to look at having a different way to measure and manage risk in a portfolio. So the month of January in the S&P 500 was the worst January since 2009. I've got 3 different measurements on the screen. Peak to trough, in case you're not familiar with the term, is the high, the peak or the high of the mountain, to the trough or the valley. So peak to trough is down. The S&P was down about 9.8%. In January, down about 5%. And then currently, again, before today's open, we're down about 7% for the year. The NASDAQ had the worst January since 2008. Okay, so a very tough start to the year. So I want to talk a little bit about what we call the VSI. That stands for Vertical Speed Indicator. For those, you may know this, you may not. VSI is an instrument on an airplane panel. If you haven't noticed, I've got airplanes pretty much all over my office. So there's a reason why I call it that. But the VSI is a made-up indicator. It is comprised of 14 different individual indicators that I'm rolling up into one indicator with the idea of having the weight of the evidence. So one indicator says this, one indicator says that. Well, if you have enough indicators, the weight of the evidence, what is that telling me? That's why I use this. It is not predictive. Okay, that's one thing we try to really hard to get across. It is not predictive. It's not telling us what the market is going to do. It's telling us what's happening right now. Are we at a elevated level of risk? That's what the VSI is trying to tell us. What we really want to talk a little bit about today, and I'll be brief because can get technical, is how does that translate into how we're actually managing money for clients? Well, this is a moderate allocation. Now, I'm not showing what we're actually invested in. There's lots of reasons for that, but I'm trying to show how a moderate model is allocated to the various sleeves that we're managing. So each one of our models is allocated to various sleeves, and each one of those sleeves are independent. We'll talk about that in a second. But why am I doing it that way? Why are we doing it that way? Well, when we look at the overall market history, many of our clients remember 2000, the dot-com bubble bursting and the global financial crisis. Well, on the screen right now is the S&P 500, and it's colored based upon my VSI signals. And so when the VSI is above 60%, I've got a green candle. That's a buy signal, a composite buy. When the VSI is below, 40%, then it's on a composite sell signal. And when it's in between, it's kind of no man's land. That's how the candles are colored. But if we zero in on that global financial crisis, it doesn't look that bad on this chart. This chart is a log chart, number one, but it's also a monthly chart. If we switch it into a daily chart, it helps us to remember that the global financial crisis in terms of the stock market correction was November 2007 to March of 2009. That was 16 months. And so one of the things that we have to think about when we're managing money for clients is their anxiety and what do they want us to do and how do we navigate those waters and things of that nature. And so what is our plan to navigate the waters? Well, when we are in a certain market environment, we want to do certain things in a portfolio. We don't always want to be full bore aggressive in every single market environment. This would be an environment where it doesn't make a lot of sense to be very aggressive because of what we were going through. So how are we looking at that? And what the rules do we have in place? Well, this is an example of the rules that we're using. Each one of our sleeves is independent of the other sleeves. And so the concept here is that we've got asset diversification because of what we're investing in inside of each of these sleeves, but the sleeves have a different strategy. Some of them are similar, like the dual momentum sleeve and the VSI sleeve are actually very similar, but we have time frame diversification here as the VSI sleeve is using monthly signals versus the dual momentum sleeve is using daily signals. Okay, and so in the environment that we're in, we believe we need to be active and we need to run the models independent of, or the sleeves rather, need to be independent of the other sleeves because there is no single strategy that is always going to work. That's why we have strategy diversification. The idea being no matter what the market is going to throw at us, we have a strategy for that. Okay, so hope that helps. If you have any questions on that, by all means, feel free to reach out to me and the team. Happy to explain that in more detail. I know that was brief, but it is intentional to be brief just because I don't want to get into too much of the weeds. But again, hope that helped. And if you have any questions, feel free to reach out to us. In the meantime, we thank you for watching.